Welcome to The Explainer. Today we're diving into Lending Club's latest earnings call. But here's the twist. We're skipping all the prepared remarks and jumping straight to the good stuff, the Q&A with the analysts.
All right, so let's get right into it. See, we're not going to focus on the polished, pre-written speeches. Nope. We're going straight to the heart of it all. The questions from the financial analysts. I mean, this is where you really find out what's going on, right? It's where management is put on the spot.
So here's how we're going to break down that Q&A. We've pulled out 4 big themes. First, the funding engine. Then, we'll look at competition and risk. After that, we'll dig into their growth strategy. And finally, we'll wrap up with what the future holds for capital and customers.
All right, let's kick things off with our first section, the marketplace funding engine. I mean, you gotta follow the money, right? For a company like this, the absolute #1 question is always going to be, where are you getting the cash to lend? Especially when the market's a little jittery.
So you can imagine the first thing on every analyst's mind. They're seeing volatility out there. They're hearing about competitors stumbling. So they asked point blank, are the big institutional investors who buy your loans getting cold feet? Is that well of money starting to dry up?
And this is where things get really interesting. Listen to the CEO's answer. He basically says, yeah, we hear that too. But then he flips it. He suggests it's not a bad thing for them. It's what you'd call a flight to quality. Investors are getting pickier, sure, but they're picking them.
So how do they actually pull this off? Well, it all comes down to flexibility. They're not putting all their eggs in one basket. You can see here they have a bunch of different channels, selling whole loans, creating structured products, even holding loans on their own books. It lets them be opportunistic and go wherever the best deal is.
So let's boil it all down. What's the takeaway on funding? Well, management's message was loud and clear. Demand is very strong. They're not just surviving, they're actually attracting new kinds of money with new products. And hey, getting a $1 billion vote of confidence from a name like BlackRock, that definitely doesn't hurt. Their whole strategy is about having enough loans to keep both the marketplace and their own balance sheet happy. Okay, so if the money's there, what's the next big worry? Well, it's all the stuff they can't control. So naturally, the analysts started poking at competition and the overall risk out there. Are they staying disciplined?
It's kind of funny. When they were asked about competition, they basically said the battlefield just keeps changing. A little while ago, when rates were different, their main rivals were the big traditional banks. Now, the banks have pulled back a bit and they're duking it out more with other fintechs. The faces change, but the fight is always on. But here's the key. The CEO made it crystal clear they are not going to get sucked into a race to the bottom. They're not going to just open the floodgates and lower their credit standards to juice their growth numbers for a quarter. Why? Because now that they're a bank, they have to eat their own cooking. They hold these loans themselves. That really changes the game. But the analysts, they kept pushing on this point. They're seeing data from all over the industry that shows credit quality is starting to crack, especially for borrowers with weaker credit scores. So they asked, are you guys seeing this too? And their answer was, well, it was a big number. They said their loans are performing about 40% better than the competition. And the reason, they claim, is simple. It's that discipline we just talked about. When others were chasing risky loans, they just didn't.
Okay, let's pause for a second, because this is a bit of a puzzle, right? If funding is solid and you're being super strict on credit, how in the world do you grow your loans by 37%? That's $1 million question, which brings us to their growth strategy. So what's their secret? It's not some crazy newfangled invention. It's actually kind of back to basics. They're just turning back on the marketing channels that have always worked for them, like direct mail. And they're not just turning them on. They're obsessively tweaking and optimizing everything, from their targeting models to the ads themselves. And this chart right here, this is huge. Think about it. They're spending all this money on marketing to find new people. But even with all that effort, a full half of their business comes from people who've already borrowed from them before. And you know what? Getting a repeat customer is way, way cheaper than finding a new one. And that's what the CEO means when he talks about their flywheel. These repeat customers are like a secret weapon. They cost less to bring back in the door, and they're less likely to default on their loans. It's a total win-win. And because these customers are so valuable over their lifetime, it means they can afford to spend a little more to bring in the next wave of new customers, which just keeps the whole thing spinning. All right, last section, the home stretch. The present seems pretty solid, so now everyone wants to know, what's next?
The questions turn to the future. What are they going to do with their money, their brand, and what new stuff is coming down the pike? So, an analyst basically points out that Lending Club is sitting on a mountain of capital. I mean, look at this. Their key capital ratio is at 18%. The regulators only requires 6.5. So the question is, what are you going to do with all that extra cash? And the CFO's answer was super straightforward. We're going to use it to put more loans on our own books and grow the bank.
Now, this was pretty cool. They also answered some questions from regular, everyday retail investors, and we got a few tidbits. A big one is that a rebrand is coming. They're getting ready to change how people see them. They don't want to just be the personal loan company anymore, which, hints that a lot more products are on the way.
So when you put it all together, what does this Q&A really tell us? You've got a company that feels really good about its funding, that's staying super disciplined on credit, and that's carefully firing up its growth machine again. But more than that, it feels like they're setting the table for a massive change. So the question that leaves us with is, after almost 2 decades, is Lending Club about to completely reinvent itself? What is that going to look like?